Hello, everyone, and good evening. Welcome to the debut episode of Daily Finance Wrap. I'm Avan Dabash. This is a one of a kind daily personal finance show that's streamed right here on YouTube every evening at 6 p.m. And we're going to be talking about everything to do with your money, from investments to insurance, tax to loans. We get you the news of the day that may directly affect your finances. And not just that, we'll also be joined by personal finance experts who'll be guiding you on how to become smarter with your money. So do tune in every day, 6 p.m., right here on Personal Finance TV. Now let's begin this topic for the day. Today we'll be discussing SIPs. It's at a time when SIPs don't work. We often say SIPs or systematic investment plans are the best way to invest in mutual funds. But depending on your circumstances, there might be other methods of investing as well. So, what are these circumstances? And more importantly, what modes should you use then? Today, I have with me Mrin Agarwal, who's financial educator and CEO of FinSafe India Private. Thank you so much, Mrin, for joining in. And I think there's so many pertinent questions regarding SIPs not working. What mode should one use? So let's just dig deep and find out a little bit more about that and what the correct investment tools should be. So let's begin and talking about who the right person or the right profile you think should be for SIPs.
So, good evening, Avan, and it's so lovely to be here today in this debut episode. And of course, systematic investment has become very, very popular. So, SIPs are meant for everybody. Anybody can invest into an SIP. Of course, given the fact you also have SIPs both in debt and equity. So, of course, given the fact that equities tend to be volatile, typically equity SIPs would be more meant for people who have at least 7 to 10 years to hold the investment, but debt SIPs can be done by anybody in any age group, because ideally a debt SIP can be done for 1 to 3 years also. So that's how one should really look at what sort of an SIP to do, which is basically what is your holding period and what is the risk involved in this particular holding period, and if you can actually take the risk. So it's not that older people cannot do it. So let's say the retired people cannot do it, they also can do SIP, provided they have the risk taking ability and the ability to hold on for the long term as well.
Mm. So, when you recommend SIPs, Amrin, to people, are there any prerequisites? It's something that people should really keep in mind whether or not, yes, a systematic investment plan is for me or not.
Well, I think apart from what I mentioned, I
Yeah.
think the way you choose the SIP is really important. So, of course, it's a well-known fact that most investors tend to choose funds that are recently performing well, and go with funds that have given fantastic returns maybe in the last 1 year. But the problem with that strategy is that, well, firstly, it could be something that you may not be comfortable with in the long term. So I think the basic rule in the SIP is really that you need to be you need to ensure that first of all you have a long term holding period, and two, you're choosing the subcategory, which is, let's say, in equities, large cap, mid cap, or small cap. You're choosing it based on your risk taking ability and not choosing something just because it's given a great return. So I would like to give an example here. Just at a recent family event, I met an older person who said, I've invested in SIPs and I have made like this 40% return in the last 2 years. And I said, great. And he said, so, now I see that this particular category is doing better and I want to go into that. And even if the risk is higher, I'll still get like a 20% return even if the markets fall. So, I think what is happening is that a lot of people are not choosing the SIP based on the sort of risk that they can actually take.
Hmm. Yeah, and you did bring up the point, talking a little bit about the way you choose SIPs. That's very critical. Can you elaborate on that? Can you tell us a little bit more about how one should be choosing SIPs?
So, firstly, social media should not be the place where you're getting information. Avan, every day I get a lot of queries. And one of the things that I'm noticing is that people are looking at social media videos which are, which are very sensational in nature. So, for example, I myself came across this video that talked about making 200 crores through SIP, and the gentleman out there was saying that the small cap fund has given 30% return in the last 5 years. So, assuming a 30% return, he said that in 30 years, you can actually make 200 crores, right? So, first and foremost, do not fall for these videos that are just meant to kind of titillate you, or, the grab eyeballs, basically. The Most of these fin influencers or such sort of videos where they're talking about very large numbers and very, very high returns, it doesn't work out. So I think, the first thing is to have your expectation on returns in order, and certainly, not expect this 30% sort of a return. The second thing is also that you need to diversify well. What I've typically seen is that currently, of course, there's this huge inflow into sector and thematic funds. So again, don't go in for something just because it's trending right now. Does it really have a place in the portfolio? Does it tie in with your risk? Secondly, what I notice very often is that people tend to choose funds from the same AMC. So what happens is that they are not getting a style diversification because of that, right? So they have a large cap fund or a mid cap fund and a flexi cap fund from the same AMC. And the third thing is that it is very important to diversify within, let's say, large cap, mid cap, and small cap. We cannot have like just one strategy and say that, okay, we'll only do, like, for example, when people talk about passive investing, they tend to just go and pick up three Nifty 50 index funds. And that's not going to help in diversification, right? So I think it's very important. Like, these are two basic things to look at when you are trying to figure out what SIP to get into.
And, I like that you said that don't fall prey to all of these sort of gimmicky things when it comes to SIPs. And then there's that question that always looms large. And is there any truth to this, Mrin? Tell us that SIPs deliver higher returns than lump sum.
I don't think it's like, one can't say that this is better or that is better. Of course, it depends on the period of investment. But what I can say is that when the period of investment is long enough, let's say 10, 15 years, there is not going to be that much of difference. The only the benefit that you get in the SIP is, of course, the flexibility and ease of investing on a regular basis. But so essentially, SIP really helps to bring down the volatility in the investment. It doesn't mean that you'll automatically get a better return just because you have invested in an SIP.
Yeah, fair enough. But we were talking about debt mutual fund investors as well, and they generally tend to be very short-term investors. What's the outlook for them, or what's the advice rather for them? Is SIPs the right investment tool?
I think it's just a matter of what is more convenient to the individual. Ideally, I would say that the lump sum is a better way to go. But if you cannot do a lump sum, then SIP is okay too. But ideally, lump sum works better, especially when you are in a falling interest rate market.
And you also, highlighted the point about diversification. So, can you give us a typical sort of portfolio allocation into the large, mid, the different types of funds, and what you would typically advise an investor who has a decent risk appetite and wants to make a decent sum of money, doesn't have sky high expectations, is what I mean.
So I think a simple portfolio that will work at all times. That doesn't mean that it's not going to fall. If markets fall, obviously the portfolio is also going to fall. But a simple portfolio that can be held for the long term is a combination of a Nifty 50 index fund, along with a flexi cap fund that can give you international exposure as well, and an actively managed mid or small cap fund. And I think these are the only three or four funds that you actually need in your portfolio. You don't need all these concentrated funds like thematic funds or sector funds, because in any case, the high conviction bets from these are going to be there in the broad based funds. So I think a combination of a Nifty 50 index fund, a flexi cap fund, and a mid or small cap fund is all that you need in the portfolio.
Okay, yes, indeed. And now I believe that as well, it is ever so easy to invest in SIPs. The SEBI has actually mandated that an investment amount of 100 rupees for lump sum investments and 500 rupees for SIPs. So, can you elaborate a little bit more on how this really makes it easier for investors, maybe beginners who have not dabbled in mutual funds?
Well, yes, because you do have still a large section of the population that hasn't invested in mutual funds. So, this basically helps with financial inclusion, and it allows more people to access mutual funds as well with the limited savings that they might have. So, they do get an opportunity to participate in the equity markets with whatever funds are available to them. So, I think it's a great move because it allows more and more Indians to take part in the India story.
Yeah, fair enough. I'm sure. But give us a sense, really when it comes to the approach that people use. Because some people tend to say that when the markets are continually rising, when the markets are high, maybe I'll pause my SIP at a time like this. Is that the right approach? Or, maybe when the markets start cracking, that's when the panic button, everyone sort of hits the panic button and says that maybe now SIPs are not for me. I can't bear to look at my portfolio like this. So I think also having a very disciplined approach and patience, would that be key?
Of course, that is the key, to making the money. So I'll give you two situations. I mean, there are three situations, honestly, in which people uh, do not remain invested in the SIP. So the first is when markets are high, then many investors believe that they can actually exit and wait for markets to fall and then re-enter. Now, what is happening is that markets are constantly making higher lows, and honestly, we all know it's impossible to time the markets. There's this very interesting data that I saw in one of the DSP reports, which showed that the average 5 year return, even when invested at an all time high, was actually 14%. So that's pretty good. Now, point number two, you have a fair number of investors who do a lot of trend chasing, right? So, for example, when small cap is doing well, they'll exit their, let's say, large cap SIP, move into the small cap SIP, and then whatever is doing well, they'll keep jumping. So this is very, very, very common, right? And if you look at it, the average, you talked about patience, there is data to show that a majority of investors actually don't even hold SIPs for 5 years. Like the typical period is 2 to 3 years because of all of these reasons. So again, there was this data point that showed that when you look at 10-year rolling returns, and let's say you did this trend chasing, so whenever you started with mid cap and then you kept switching to whatever the best performing index was, so when you did that, the returns were actually lesser than if you just held on to the mid cap index, right? So honestly, all of this churning, this moving in and moving out, does not really work out. Of course, when the markets are down, that is the best time to actually add money because you're going to get more units. But that is the time that you will see a lot of people exiting or pausing the SIP, and thus impacting their SIP returns in a big way. We saw it in 2020 in COVID. So certainly what really helps is just choosing right. I think that's really important, and just remaining invested.
Yeah, and I think to a great extent as well, SIPs sort of bring that very disciplined approach to investing. Can you just walk us through some of the other benefits of investing via the SIP route? I believe that, of course, it enables investors to buy more units when the prices are low, fewer units when the prices are high, and that sort of just averages your cost of investments over time.
Yes, and I think SIP has a lot of behavioral benefits, because what happens is that on our own, if we have to keep thinking every month to invest this money, we may not have the time, then every time you're going to be thinking, is this a good time to invest or not? So I would say that if SIPs really effectively take the emotions out of investing, because that money is going every month. Now, it's also a great tool to do that regular saving, because if that money actually hits your account, or if that that amount that you're planning to put in SIP, if it remains in your account, and most likely it's just going to get used up, right? So it's a very good tool for automatic savings. It's a again, it's easy to invest because you don't have to figure out, is it a good time to invest, is it not a, what do I do at this point in time, and you're not having to take this constant decision on a monthly basis, right? So I think from a behavioral aspect, I think SIP offers a lot more benefits, apart from, of course, the rupee cost averaging and the ease and the convenience of investing.
And the sort of the proof is in the pudding in terms of the kind of data and the kind of numbers as well that we've been seeing. You've had monthly SIP levels that have crossed 23.5 lakh crores for the first time in the month of August. The equity inflows have grown about 3%. We've added almost 80,000 crores inflows in thematic funds. Can you just tell us about how you're looking at the overall trajectory as well of SIP flows and retail investors' participation?
Yeah, I think it's going good. My only concern is really on the inflows into the thematic category. And it's really driven by the fact that you've seen some great returns on certain themes and certain sectors. But and of course the fact that, so I think one of the things that really people need to keep in mind is that markets can fall, because for the last 3 to 4 years we are seeing this raging bull market, and everybody is making very nice double digit returns in a very short period. So I'm seeing a lot of overconfidence from investors, thinking that nothing can really go wrong and we'll keep making this 20% return, and that certainly may not happen. So, and of course, choosing these very concentrated funds based on performance. We saw last year the same thing in defense and PSU, and now that you've seen the correction in these sectors, you can see that it's not like this performance is going to continue year on year. So I think some bit of doing a reality check and really thinking through whether we've done the right investments or not is really required at this point.
Okay, yes, fair enough. That is also fairly critical. So, Min, thank you so very much for giving us that advice, telling us a little bit more about, I think, what everyone needs to know, how you should be choosing SIPs, the right approach, not getting lured into any of these social media hacks, and investing in a disciplined and patient manner. It's been a pleasure having you on board. Thank you for joining in.
Thank you for having me.
All right, that aside, now let's move on to some more news and updates. And with effect from today, the transaction limits for UPI payments have been changed. It'll now be possible to have a single transaction of up to 5 lakhs with the earlier limit of 1 lakh using UPI for specific purposes. Sorry. So, what are those transactions? Firstly, tax payments, and secondly, the payments to hospitals. Sorry about this. And educational institutions and RBI retail direct schemes. And just before we wrap up the show, here's a quick finance tip. For more effective money saving and budgeting, create a separate savings account for your expenses. When you get your salary at the beginning of every month, if you can transfer a certain amount to your expense account, only spend from there. This will automatically help create savings and set you on the path of prudent savings. And with that, it's a wrap. Thanks for watching.